So we just got the latest GDP numbers for Q1 of 2025, and for the first time in 3 years, the US economy actually had negative growth. The GDP came in at negative 0.3%, and now we are having a 74% chance of a recession with these latest numbers. We also got payrolls earlier as well that stated that the private sector is having less jobs than everyone anticipated. The numbers were actually 50% less than everyone was anticipating. And as you can see earlier, as the numbers came out, the US stock market was down over 2%, but actually those numbers have recently changed. Now we do have oil here on the right, down 3% at the time I'm making this video. And if you're not aware, oil is a recession indicator. The reason oil drops leading up to a recession is because investors are pricing in less economic spending, less travel, less consumer spending overall, and oil is a big factor when considering all of this. So we're going to take a look at the odds of a recession, because this is showing 74%, but if we actually look at the poly market, which has accurately predicted the US presidency, the Canadian prime ministers being elected, the poly market has been pretty accurate, and as of right now, there is a 64% chance of a recession, which is up from earlier in the year, only showing a 23% chance of a recession. So as of right now, it's looking like we are likely going into a recession in 2025. The expiration for this is February 28th. Now, I don't bet on any of these. I don't use Polymarket or Kalshi, but I'm just using it as a potential prediction tool because it does look like we are likely going to enter a recession later this year. This is showing a 64% chance. Other economists are showing a 74% chance. I know there are some, JP Morgan, they're only estimating 40 or 50% chance that we go into a recession. But if we actually look at the Atlanta Fed numbers, their prediction for what the GDP was going to be in Q1 of 2025 was negative 2.8%. Thankfully, we did not get that number coming out in Q1. If we would have, the stock market probably would have fallen off a cliff. We would have had likely another negative 5% day. Thankfully, only negative 0.3%, but I do want to remind everyone that we had 2 consecutive quarters of negative GDP in 2022, and a recession was not called, and that was primarily... But I do want to remind everyone that we had 2 consecutive quarters of negative GDP in 2022, and a recession was not called, and that was primarily because the job market was being held up so well. As of right now, unemployment rate is still below 4.5%. We'll have to wait and see if that changes later in the year. I would expect it to get above 4.5% by the end of 2025. There are a lot of companies having layoffs. As I mentioned earlier, private sector is hiring significantly less people than everyone anticipated. So we'll see how the unemployment actually changes later in the year. Now, let's look at the actual GDP numbers and you'll see why it came in negative. So imports soared 41%, driven by a 51% increase in goods, and you subtract imports from the exports, and that's how you get GDP. So that's why GDP came in negative at negative 0.3%. Now, if we get negative GDP in Q2 of 2025, you are probably going to have a recession declared, especially if the unemployment rate carries on going up, which I expect it to with all these government layoffs happening, which was a large reason why the unemployment rate was so low when we got 2 consecutive quarters of negative GDP in 2022. Now, I do want to remind everyone that usually, historically, I love studying recessions. I've studied all of them. If you look back as to when recessions are actually declared, oftentimes that is near the bottom of where the stock market is. So if you're Hey! You know what? Get your ass up here. Now, I do want to remind everyone that usually when a recession is actually declared, I love studying recessions, I've studied all of them. Looking back in the past, a recession is actually declared when you're almost on the brink of exiting a recession. Now, is that going to happen again this time? I have no idea. Obviously, there are a lot of factors at play, unemployment being the primary one, and I would expect consumer spending to decline going into 2026 because the consumer is tapped out. We have credit card debt at an all-time high. We have credit card interest rates at an all-time high. Layoffs are continuing. We're seeing a lot of tech companies, which is a driving factor for consumer spending, as they have an enormous amount of employees who make a lot of money. And if those layoffs in high income sectors carry on going up, we will have likely a pretty decent recession. If you're unaware, the top 10% is making up over 50% of all consumer spending. So if you have a lot of high income earners getting laid off, that reduces the amount of consumer spending that is happening in the economy. Now, looking back at what economists surveyed the Dow Jones, they were looking for a gain of 0.4% after GDP rose by 2.4% in the fourth quarter of 2025. However, over the past day, some Wall Street economists changed their outlook to negative growth, largely because of an unexpected rise in imports as companies and consumers sought to get ahead of the Trump tariffs implemented earlier in April. So essentially what this is saying is they wanted to get ahead of the rising potential costs that tariffs were going to give a lot of these companies from importing from China and other countries. So they bought a lot of goods leading up to the announcement of the tariffs because they didn't want to deal with that additional cost. So it'll be interesting to see how the inflation numbers play out if all of these companies were buying excess amount of goods leading up to the tariff announcements. You're probably going to have inflation tick up slightly for a month or two, especially if tariffs increase the cost that all of these companies are going to have to pay. Now, in my opinion, inflation is going to continue going down in the long term. I think we're actually likely going to have deflation. If you think about what causes inflation, it's consumer spending, and that has been declining basically for the last 12 months. So if consumers stop spending, which they definitely are going to, especially if the fears of a recession actually become real, it's just psychologically, you don't want to be spending excess amount of money going into a recession just in case you get laid off. You want to have a lot more spare money in the bank account to make up for potentially not having a job for a few months or even 6 months. I know there's a lot of people who have been unemployed for quite a while, as the job market is pretty rough right now. I've heard some people applying to thousands of jobs and continuing to get rejected. Some of them are having 10, 12 interviews and they're still not getting the job because the company actually changes their mind and says, actually, we're not looking for this position. So it's going to be very data dependent on what happens later in the year. Now, as far as how this is going to affect the housing market, mortgage rates will likely decline in the second half of 2025, especially if we continue to see the data proving that we are going to go into economic contraction. Remember, mortgage rates are forward-looking, so we don't actually need the Federal Reserve to cut rates in order to reduce mortgage rates. You're probably going to have multiple rate cuts in the second half of the year, but if the expectations, if the odds of rate cuts increase in 2025, we are likely going to have potentially sub 6% mortgage rates in the second half of the year, maybe even 5.5%. So that is going to open up the opportunity for more home buyers to step into the real estate market, because I know there are a lot of people that are kind of just waiting on the sidelines for lower mortgage rates. They don't want to buy a house with 7% rates if they think mortgage rates are going to drop later in the year. And history does show that as the unemployment rate increases, mortgage rates decline because the Fed needs to step in, boost the economy, make it cheaper to borrow money to boost economic expansion. So we'll have to wait and see how everything plays out. If we get inflation confirming a downtrend, which I believe it has. Now, if we enter deflation, this is going to be a completely separate video, inflation versus deflation, then you're probably going to have a larger recession than a year. You might have a longer one, maybe 2 or 3 years. Still data dependent. We'll have to see how everything plays out. But that's it for recession odds, GDP numbers that recently came out. If you like this video, subscribe for more. My name is Ian Phillips. I'm a realtor in Southern California, and I love economic data. I love housing data, so I'm uploading almost daily videos diving into what's going on in the economy and real estate. I'll see you in my next video.